Good morning, everyone. So, new chapter. The title of new chapter is long-term liabilities. Okay, so this is the main title, but we'll learn something others that are not always related with long-term liabilities, but this is the title. So, financing corporations. For example, your business need money. Okay, if your business needs some money, so business has several sources to collect this kind of money. So corporations finance their operations. So in order to run the business, operations, okay, they need finance, they need money. They need money, and they can collect this money from several sources. They can collect this money from several sources. Who are the sources? The first one is short-term liability. So what is the duration of short-term liability? It is within 1 year, right? So you are liable to pay back within 1 year, or we can say less than 1 year. So this is called short-term liability. So you collect some money from other people and you are liable to pay back this money. You are liable to pay back this money within 1 year or less than 1 year. So this is called the short-term liability. So what are the examples of short-term debt? You purchase goods or service on account. Okay, you purchase goods or service on account. What is the meaning of on account? Can you remember? On account means on credit, right? On credit. That means you buy something, you buy goods, you buy service, but you have not yet paid any cash. Okay, you have not yet paid any cash. So you are liable to pay this cash within 1 year or less than 1 year. It is called short-term liabilities. Again, what is the meaning of long-term liabilities? So the duration is something like this. Is the duration you are liable to pay back more than 1 year. That means you can hold this money more than 1 year. This is other people money. You collect money by selling bonds. Okay, you collect money by selling bonds or you issue notes, and you collect this money, and you can hold this money for more than 1 year. Like you can hold this money 5 years, 10 years, 20 years, 50 years, something like this. So this is other people money, but you can hold it for long time. So that's why it is called long-term liability. So this is our main chapter. This is our main chapter, long-term liability. So in this chapter, we'll talk about mainly bonds. We'll talk about mainly bonds and the notes. And we already know that this is other people money, but we can hold it for long time. So we have another concept we have to learn from this chapter also. It's called equity. So we have two types of equity. One is called common stockholders equity, and another is called preferred stockholders equity. So these are the categories that help us to collect the money. So look at the example here. So we are talking about sources of money, sources of finance. So this is the asset part. You know that this part belongs to the business, right? This part belongs to the business, and these two parts are the outsider. Owners and the business are not same, you know that. If you remember your principles of accounting 1, okay? So principles of accounting 1, we have one concept called business entity concept. Business entity concept said that owners and business are separate, they are not the same. For example, I am the owner of this business, I am owner of this WKU. We should separate. Why? Because if I die today, do you think that the business, the WQ will also die with me? No, right? So we have separate relationship. So that's why asset belongs to business and this part are separate. Liabilities is the other people, owners are the other people. Now, if a business want to run, business need money, right? Business need asset. Without asset, like this building is the asset, right? Without this building, you people will not come here. So this is the asset of this business, and our university need this asset to run the business. So if a business need asset, for example, cash, they can collect this money. They can collect this money from this kind of sources. They can collect money from short-term liability. They can collect money from long-term liability. They can collect money from owners like preferred shareholder, and they can collect money from common shareholder. Clear? So look at this example with dollar amount. For example, this business need $100,000. Okay, $100,000 they need. And how they can collect this money? They can collect this money from liabilities and from equity. And from liability, they collect $30,000, $20,000 from long-term liability, and $10,000 from short-term liability. And for equity, $70,000, they can collect this money by selling preferred stock $20,000 and by selling common stock $50,000. So if we add all this together, that means if we add 20,000 and 50,000, it is 70,000, and 10,000 and 20,000, 30,000. If we add this to money, it is $100,000. Now business use this money, okay, use this asset to run the business. So this is called the sources of finance. Do you understand what is the meaning of sources of finance? If you need money, you have several sources to collect the money. Now, we are going to learn earnings per share, this concept, earnings per share. For example, here, we know that we have two types of stock. One is called preferred stock, and we have common stock. We have two types of share, preferred stock and the common stock. So if I ask you a question, what is the difference between these two? Who is more preferable? Because we have two types of shareholder, preferred shareholder and common shareholder. So preferred shareholder are more preferable, right? Why they are more preferable? Because they will receive dividend. Dividend is their earnings. Okay, if you buy preferred stock, you need earning, right? Preferred stock means here. Preferred stock means you invest $20,000. Why you invest this $20,000? Because you need some return, right? You need some return. You need some return. So dividend is the earnings actually. Dividend is the earnings if you buy share. So the preferred shareholder will receive dividend first. Okay, dividend first, and their dividend is fixed. Their dividend is fixed because if you buy preferred dividend today, preferred share today, okay, today you already know what is your dividend. Today you already know what is your dividend. For example, you purchase 10,000 preferred share. Okay, you purchased 10,000 preferred share, and I already told you that today you purchased, and today you already know, okay, and their dividend is fixed. You already know their dividend. For example, 10% is dividend. 10% is dividend. So this information you know from the very beginning. This information you know from the very beginning. That means you are the preferred shareholder. You are the preferred shareholder, right? So these are the characteristics. You are the preferred shareholder. So you will receive dividend first. Okay. And you will receive dividend first. And your dividend is fixed. Dividend is fixed. And this is the example. You purchase 10,000 shares, 10% is the dividend. So $1,000 is your dividend. So $1,000 is the dividend, okay? Is the dividend for the preferred stock. Clear? So you already know this information. But if you buy common stock, okay? If you buy common stock, okay, when you will receive dividend? So you will receive dividend after paying dividend to the preferred shareholder. You will receive dividend. Do you understand? Look, they receive dividend first, right? After paying this dividend, you will receive dividend after paying dividend to the preferred stock. And dividend is not fixed. You can find any amount of dividend. Okay, you can receive any amount of dividend, but look at here. This is fixed. $1,000 is fixed, right? $1,000 is fixed. $1,000 is fixed, but their dividend is not fixed. Now, as their dividend is not fixed, we are going to calculate EPS, earning per share, okay, to know what is the amount of dividend so we are going to calculate EPS to know what is the amount of dividend for common stockholders. So that's why the term EPS came. Clear? Okay. Now this is the definition of EPS. This is the definition of EPS. Earning per share measures income earned. So if you earned any income from the business, it is called dividend. And dividend, it is called the dividend. That means dividend came from income. Okay. So here you are the owner. You can see that these two people are the owner. Preferred shareholder are the owner, common shareholder are the owner. If there is any net income, this is their money. right? It is their money. So as it is their money, and from principles of accounting 1, you learned that. Can you remember what is the definition of dividend? From principles of accounting 1, what is the definition of dividend? So here I use the term dividends. What is the meaning of dividend actually? Dividend means this came from net income. Okay. If you receive your net income from business, it is called dividend. Very simple definition. If you receive cash from your net income, because you are the owner, right? You are the owner, net income is your money. Net income is your money. And when you receive this net income from business, it converted as a dividend. That means net income will decrease, right? Net income will decrease and it goes to your dividend account. Clear? So dividend is the part of the net income. So earning per share measures income earned by each share of the common stockholders. So we are going to use EPS to calculate how much dividend they are going to receive. Because we no need to calculate EPS for preferred shareholder. Do you understand? We no need to calculate EPS for preferred shareholder. Why? Because preferred shareholder already know what is their dividend. What is their dividend? But common shareholder don't know what is their dividend. So we are going to use EPS method to know what is their dividend. Now look at this formula. This is the main formula. Earning per share. Earning per share means this is the net income. I told you that net income is your money, right? You are the shareholder. So here we have 40 people, for example, here. We are the shareholder. And net income is your money. And from net income, who is received dividend first? Preferred shareholder will receive dividend first. So after paying preferred dividend, remaining money goes to common shareholders. Okay, remaining money goes to common shareholder. For example, come this part here. For example, randomly I said that net income is $50,000. Net income is $50,000, and because preferred dividend is fixed, right? Preferred dividend is fixed. For example, it is $10,000. $10,000. So $50,000 preferred dividend is $10,000. What is the remaining amount? Remaining amount is $40,000. This $40,000 goes to common shareholder. Okay, this $40,000 goes to common shareholder. Now, how much money for each shareholder? We are going to use this formula EPS. So when you will find this question EPS, so you have to think that you have to have this information. You have to have net income. So you have to calculate net income. You have to calculate net income first. Then you have to calculate preferred dividend. So this part is easy because it is fixed. It is fixed. You have to calculate the preferred dividend. How to calculate this? I already show you here. This is a simple calculation. Okay, 10,000. That means 10,000 times 10%. Okay, so you have to calculate preferred dividend. Then you have to calculate number of then you have to calculate EPS. So to calculate EPS, you have to go through this way. You should have net income. Okay, you should have net income. You should have preferred dividend. Okay, you should know how many common shareholder we have. Okay, then we have to apply the EPS formula. Okay, we have to apply the EPS formula to get this number. Now, these are the steps you have to follow. Okay, these are the steps you have to follow to get the answer. So first you have to read the question and you have to find out this information: earnings before interest and income tax. So what is another name of earnings? Another name of earnings is called income. Okay, another name of earnings is called income. So you have to find out what is the amount of income before. Try to understand. Income before interest and income tax. So here we have one point is called interest expense. Another is called the income tax expense. Now, what is interest expense? Go back here. Think about long-term liability. This $20,000. I give you $20,000. Okay, I give you this $20,000 for 5 years, for example. Is it free? You ask me money and I give you $20,000 for 5 years. What is my benefit? I give you this money. What is my benefit? So I know this benefit, you know this benefit, that if you buy preferred stock, you will receive dividend, right? If you buy common stock, you will receive dividend. If I give you money to you, what is my benefit? Interest. Yes, you have to give me interest. Okay, so this is called interest expense. So this part is the interest expense. So from your income, okay, from your income, you have to give me interest. Okay, so you have to give me interest. So you give me interest, and government is waiting for you. If you have any income, government said that you have to give me income tax. You know that, right? So you pay interest expense, you pay income tax. Okay, so this is called before. That means before means you have not yet paid. Okay, before means you have not yet paid interest expense, you have not yet paid income tax expense. Now we are going to pay it. So earnings before interest and income tax minus interest expense, equal, it is called earnings before income tax, means it is called EBT. This is called earnings before income tax. Okay, earnings before tax, something like this. This is EBT. Now from here you are going to pay income tax. So don't forget that. Don't forget that this is first you have to pay. First you have to pay interest expense. Okay, first you have to pay interest expense, then you have to pay income tax. So you cannot pay income tax first. Okay, in the real business world, you cannot pay income tax first, then interest expense. No, in the real business world, you must pay interest expense first. After that, you have to pay income tax. So after paying interest expense, after paying income tax, okay, the equal is net income. So here, for example, this is the random number. This is not actual number, this is a random number. Okay, for example, our income is $50,000. So this is the net income. No one can claim this money except owner. Okay, because company already paid interest expense, company already paid income tax. So this money is only for the shareholders. Who are the shareholders? That means you are the owners. Okay, this money is only for you. Now, as this money is only for you, this money is going to pay as a dividend. This money is going to pay as a dividend to whom? To preferred shareholder first. Okay, so preferred shareholder received $10,000. Okay, after that, the remaining money goes to common shareholder. Now, this is the available money for all common shareholder. This $40,000. This $40,000 is available for all common shareholder. I give you one point here. Number of common number of common shareholders. Number of common shareholders are 10,000 people. Now, if this is the case, what is the EPS? What is the EPS? So 40,000 people for how many people? $40,000 is for 10,000 common stock people, right? Now, what is the earning per share for common stock? $4, yes. Yes, $4. So this is the case. 10,000 shares. $10,000 common stock. So we have 10,000 common stock and EPS is $4. And how we get EPS? By applying this formula, right? Net income minus preferred dividend divided by number of common stockholders. We get this. Now read exercise 1. A short question for you. A short question for you because that income statement of this corporation shows income before interest and income taxes. Okay, so EBIT is given. EBIT is given $700,000. Interest expense is given. Okay, so EBIT $400,000, $700,000. Interest expense $100,000. Income tax expense $100,000. Preferred dividend is fixed. I told you that preferred dividend is fixed. It is $10,000. How many shareholders we have? Common shareholders are 100,000. So what is the EPS? What is the EPS? So EBIT is given, income tax is given, okay. Interest expense is given, preferred dividend is given, number of shareholders are given. What is the EPS? So if you go this way, you will find the answer. Okay, you will find the answer, and this is 4.90. Now we are going to discuss more important exercise, because in the exam you will not have easy question like that. Okay, this is the overview how to calculate the EPS, but this is your exam question. So I told you that this business need, if you come here, this business need $100,000. Okay, this is $100,000 business, and these are the several sources. These are the several sources to collect this money. Now look at this example based on this diagram. Based on this diagram, assume that this corporation is a $4 million company. That means they need asset $4 million. Okay, they need asset $4 million to run the business, and these are the options. These are the options. So we have plan 1. You can see that we have plan 2, and we have plan 3. So 3 different plans. 3 different plans to collect how many dollars? $4 million. Okay. So look at here, the last row. You can see the total amount. Total amount for plan 1, $4 million. For plan 2, $4 million, and for plan 3, $4 million. Okay, so they need $4 million. Now, according to plan 1, you can see that according to plan 1, they don't want to get this money by selling bond. Okay, and they don't want to get money from preferred stock. So they only collect $4 million by selling common stock. And per value of the common stock, that means one share price is $10. Okay, one share price is $10, and they sell shares and collect $4 million because they need $4 million. Now look at the plan 1 here. First, let me explain plan 1. So this is plan 1, you can see. This is plan 1. So according to this question, they need $4 million, right? And question said that they don't want to get any money from liability. They don't want to get any money from liability. They don't get any money from preferred stock. They only collect $4 million. They only collect $4 million from common stock, right? Look at the plan here, this plan. They don't have any bond, right? It is blank. They don't have any preferred stock, it is blank. And they buy common stock, $4 million. They collect money from $4 million. So if I ask you a question, okay, this is plan 1. This is plan 1, we find that they collect $4 million, right? They collect $4 million. By selling common stock. And per value is $10 per share. Per value is $10 per share. My question is, how many stock company sold? What is the answer? 400, right? Yes, it is 400,000 shares. So why we need this information? Why this is important information? Why we need this? Because look at the formula. Can you remember the formula? Number of common shareholder, right? Do you understand? In our formula, we should have this one. We should have number of common shareholder. So number of common shareholder, we calculate from plan 1, right? Plan 1. So I think you understand what is plan 1 about. They don't have any bond. They don't have any preferred stock. They only have common stock. They sell 4 million shares. Okay, per share is $10, and they receive they sell 400,000 shares. Okay, per share is $10, and they collect $4 million. Look at plan 2. Again, plan 2, they don't have any bond. Okay, they don't have any bond. They collect $4 million. They collect $4 million, $2 million from preferred stock. Okay, $2 million from preferred stock, and $2 million from common stock. Okay, now go to plan 2. I told you that if you buy preferred stock, from the very beginning, you know what is the amount of dividend, right? Now, can you calculate here according to this information? So from this information, from this diagram, can you calculate what is the amount of dividend for preferred stock? Because if you buy preferred stock today, you already know what is your dividend, and your dividend is fixed. From this diagram, can you calculate what is the amount of preferred stock dividend? What is the amount? It is, you buy $2 million of preferred stock, right? You buy $2 million of preferred stock times your dividend rate is 9%. Okay, times 9% equal. This is the dividend. Okay, this is the dividend for preferred stock according to plan 2. So this is we are discussing plan 2, right? Plan 2, there is no liability. There is no liability. They have some preferred stock, they have some common stock. And you know that if you buy preferred stock, you will receive dividend fast, right? You will receive dividend fast. So, and you already know your dividend. What is your dividend here? Your dividend is $180,000. Now, according to plan 2, can you tell me how many common shareholder we have? According to plan 2, how many common shareholder we have? How many? How many common stock shareholders here? I mean the number of common stockholders. How many? 200,000. Very good. Because it came from here. So if I copy this, okay, I can copy this. So company sell $2 million of common stock, right? Look at plan 2. They sell $2 million of common stock, par value $10. Okay, par value $10. That means they get 2 million shares of common stock. So do you understand plan 2? Clear, right? Go to plan 3. They need $4 million. They need $4 million. Okay. So $2 million they collect from where? They collect from bond, right? $2 million they collect from bond. $1 million they collect from preferred stock, and $1 million they collect from common stock. Total $4 million. So look at here, plan 3. So this is plan 3. They need $4 million. Okay. Now $2 million came from liability, right? Bonds. $1 million, $1 million came from preferred stock. $1 million came from common stock. Now you have to tell me. You have to tell me what is the amount of interest expense on bond? Because I told you that I give you $2 million. It is not free. You have to give me expense, right? You have to give me interest expense. Here, can you remember this formula? So you have to give me interest expense on bond, right? If I give you money, you have to give me interest. So this is plan 3. This is plan 3. $2 million is from bond. So what is the interest expense of bond? Times 12% is the interest, equal, this is the interest expense. Okay. If this is the interest expense according to plan 2, sorry, according to plan 3, what is the amount of preferred dividend according to plan 3. They sell $1 million from prepared stock, right? 9% dividend, it is $90,000. Clear? So according to plan 3, okay, according to plan 3, how many common shareholders they have? How many common shareholders they have? They sell $1 million of common stock, right? Par value $10. Par value $10, that means they sell $100,000 of common stock. Okay, they sell 100,000 of common stock times par value is $10. You know that, right? Times par value is $10 equal 1 million, right? Something like this. So number of shareholders is 100,000. So we know this information. We have 3 plans. Now why we need $4 million? Why we are considering 3 plans? What is the main reason? What is the main reason to analyze this kind of plan? Do you understand? So look at here. According to this example, if you buy common stock, what is your earnings per share? According to this example, your earnings per share is $4. That means if you buy 1 common stock, you can earn $4 at the end of the year. This is additional money you can earn, right? You invest, for example, you invest $100. At the end of the year, you will earn $104. So this $4 is your earnings. Okay. If I tell you that not 400, if it is 1000, are you happy or not? So before it was $4, right? Now I tell you that your EPS is not $4, your EPS is $10. Are you happy? You are more happy, right? So why we are analyzing different plan? Because in future you might be the finance manager or accounts manager. Okay. Then if business need this money, you are the responsible people, okay, who is going to collect this money, because you are the manager. Do you understand? You are the manager of this company and you know that you need $4 million. Now what is your intention? Your intention is to make shareholder happy. Okay. If shareholder are happy, for example, previous example, it was $4. Now if you make it $10, shareholder are very happy. If shareholder are very happy, you will have bonus. You can continue your job for long time. Why? Because you provide more money to the owner. Clear? So in future, when you will be the manager of a company, then you have to play this kind of game. And which plan will give you higher EPS? Okay, this is 3 plans: plan 1, plan 2, plan 3. So we are going to see which plan will give us higher EPS. We will select this plan. If we select this plan, that means we can earn more money, shareholder are happy, and as a manager, you can have your fixed job, something like this. Now we are going to apply these steps. For each plan. Okay. For each plan, we are going to apply this step to see which plan will give us, okay, which plan will give us the higher net income, something like this. So look at the solution. And we have additional point, EBIT is given. According to this question, so this is our question 2. EBIT, earnings before interest and income tax, is given. It is $800,000. Okay, $800,000 is the earnings before interest and income tax, and government tax rate is 40%. So after paying interest expense, okay, after paying interest expense, you have to pay 40% to the government. This is the information you are given. Let's see the solution. This is the solution. So this is the question. I just copy the question. And according to the question, I can add something more. EBIT is $800,000. I copy the question again. %. So this is your question. This is the question. Now we are going to calculate, and your requirement is calculate and this is your question. Calculate EPS for each plan. Okay, and our solution start from here. This is the solution. This is the solution. So you remember that we start with EBIT, right? Because we have to calculate net income. We have to calculate net income. So to calculate net income, we have to deduct interest expense. Then we have to deduct income tax. Then we'll get the net income. So EBIT for plan 1 is $800,000, plan 2 $800,000, plan 3 $800,000. So EBIT is similar for each plan, right? There is no difference for EBIT. So this is EBIT. EBIT is given. And this is plan 1, plan 2, plan 3. So minus interest expense on bond. So here you can see that there is no money here. There is no interest expense for plan 1. There is no interest expense for plan 2, right? Why? Can you remember this? Can you remember the question? Question said that plan 1 don't have any bond, right? Plan 2 don't have any bond. So plan 1 and plan 2 do not have any bond, so there is no expense. Clear? So it is 0. You can see that it is no money is here. But according to plan 3, we collect $2 million from bond, okay, and we promise to pay 12% interest. Okay, you give me money $2 million, and I promise you to give you 12% interest. So plan 3, we have interest expense. So I will show you the calculation here. Plan 3, look at here. Plan 3, interest expense is $240,000, right? Because we have loan, we have bond, so we have to pay interest expense. So plan 3, we have interest expense. Plan 2, we don't have any interest expense. Plan 1, we don't have any interest expense. So after paying interest expense, remaining money called EBT, earnings before tax. Okay, earnings before tax. Now we are going to pay tax. Okay, the formula is EBT times 40%. So this is the formula for income tax. So after paying interest expense, we are going to pay income tax for this money. This is the EBT, and 40% for plan 1 40% plan for plan 2 and 40% for plan 3. So after paying income tax, this is our net income. This is our net income. So according to plan 1, net income is $480,000. According to plan 2, our net income is $480,000. According to plan 3, our net income is $336,000. Okay. Now this is the net income, and owners will receive this money. And who will receive the money first? Preferred shareholder will receive the money first, right? So plan 1, can you remember? Plan 1, we don't have any preferred dividend. Plan 1, we don't have any preferred dividend, right? Plan 2, we don't have any preferred dividend. Sorry, plan 2 is, here, dividend is here. Plan 1, we don't have any preferred dividend, but plan 2, we have preferred dividend. Plan 3, we have preferred dividend, right? And we already calculated the dividend according to plan 2, you can see. According to plan 2, our preferred dividend is $180,000, right? And according to plan 3, our preferred dividend is $90,000. So we are going to pay this money first. So plan 1 don't have any preferred dividend, plan 2 preferred dividend, plan 3 preferred dividend. So after paying preferred dividend, the money goes to, remaining money goes to the common shareholder. So for plan 1, $480,000 money goes to common shareholder. Plan 2, $300,000 money goes to common shareholder, and plan 3, $246,000 goes to the common shareholder. So this is money for all people, right? All people. Now we are going to divide the people. Now, according to plan 1, I told you that according to plan 1, how many shareholders we have? We have 400,000 shareholders. According to plan 2, we have $200,000 common shareholders. According to plan 3, we have $100,000 common shareholders. So we put this number here. $400,000 shareholder, $200,000 shareholder, not dollar, sorry. 400,000 number of shareholders, 200,000 number of shareholders, 100,000 number of shareholders. Now EPS. This is called EPS. So according to plan 1, EPS is 1.20. According to plan 2, it is 1.50. And according to plan 3, it is something like this. So which plan give us higher EPS? Plan 3, right? Plan 3 will give us higher EPS. So as a manager, you have to select this plan. Okay. Now do this question, then I will explain the question 3. So now your job to solve question 3. After that, I will explain the comparison between exercise 2 and 3. Okay, so do it now. Do it now, I will show you the answer later. So I think you solved this question, right? And this is the answer actually. So now which plans going to give you higher EPS? Plan 1. Okay, now let me explain something important for managerial decision. So managerial decision, you can see that So look at this, what I copy. So managerial decision, exercise 2 versus exercise 3, right? So you can see that I keep the same question, only change is here, right? Same question, exercise 2, I just put 440,000 here, and for exercise 1, it was $800,000. So this is the only one difference. All other points are similar. So how to make a decision from the managerial perspective? So EBIT for exercise 2 is higher, right? If we compare EBIT of exercise 1 and EBIT of exercise 2, okay, which one is higher? Exercise 2 is the higher. And when exercise 2 is the higher, we select which plan? We select plan 3. We select plan 3. Why? Because plan 3 give us higher EPS, right? Plan 3 give us higher EPS. But in case of exercise 3, our higher EPS is where? Our higher EPS is in plan 1. In plan 1, right? In plan 1. Do you understand up to here? So exercise 2 and exercise 3, if you compare, exercise 2 has higher earnings before interest and income tax, right? Okay, and we find that plan 3 is better because plan 3 has higher EPS. So if you have higher EPS, sorry, if you have higher EBIT, if you have higher EBIT, you should go for long-term liability plus equity. Do you understand? Because you have higher, look at here, according to this question, you have higher earnings before interest and income tax. Now you can easily pay income tax and you can easily pay interest expense. Do you understand? Compare these two. Compare these two items. If you have higher EBIT, okay, if you have higher EBIT, then you have no problem to pay interest expense for bond because your earnings before interest and income tax is higher. Do you understand? And you are the manager, you know the internal confidential information. So this $800,000, this $800,000 or $400,000, this information is very confidential. And as the manager, you know this information. Do you understand? You are the manager and you know this confidential information. What is the EBIT? Because people will know only your net income. Outside people, look at here. Outside people only know your net income. But EBIT is only known by you because you are the internal people. Okay. So if your EBIT is higher, you can get some loan. And if you can get some loan, you can easily pay interest expense. But if your EBIT is lower, look at here. If your EBIT is lower, if you pay loan, interest expense, your EBIT will drop a lot, right? Your EBIT will drop a lot. So if you have lower EBIT, okay, then you should go only for equity. You should go only for equity. No need to get money from loan. But if you have higher EBIT, then you can go for loan and you can go for equity, both combined. Do you understand? This is very, very important point. If you are if you will be a future manager, or if you go for a CP exam, okay, they will not give you so many information like this. They will give you some information. You have to make decision very quickly. Okay, you have to make decision very quickly. So the summary point is here. You are the manager. You know the internal confidential information. If your EBIT is higher, you can take some risk. You can take some loan, okay, from long-term liability. Why? Because you can easily pay the interest expense. Even after paying interest expense, you can see our EPS is higher, right? But question 3, you can say that after paying interest expense, our income before tax become very lower. You can see here. It's become very lower, right? Become very lower. So if your EBIT is lower, then we can go for plan 1 because it will give us higher, it can give us higher EPS. Clear? Okay, so that's all for today.